Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder and this is BRN Weekly for Saturday, October 31st, 2020. And our top story today, how one pension fund explores short and long-term risks and opportunities. Well, joining me now to discuss this and more is Ann Simpson. She is Director of Board Governance and Strategy for CalPERS. Ann, thank you so much for joining us on the program this morning.
My pleasure.
So let's, a few weeks ago on the program, we talked to Bob Colley about European ESG. I think it only makes sense, in their perspective in ESG, I think it only makes sense to come to CalPERS, which is the largest U.S. retirement pension in the as I said, in the United States. So I want to get yours and the CalPERS team's perspective on sustainability. What can you tell us? How are you looking at this really innovative area?
No, it's such a good question. So CalPERS some years ago adopted an investment strategy for sustainability for the total fund. That means for all asset classes, for publicly listed companies, private companies, fixed income, infrastructure, real assets. So let me explain what we mean by sustainability and how we've approached that and why we see this as an investment issue. The first thing to know about CalPERS, as you say, Jeffrey, we're very large. CalPERS is a $420 billion plus pool of money, but that means we can't hide. So if we're dealing with an issue like, say, climate change, there's no way you can put money of that size into a safe little place in the stock market. Anything going on in the wider economy that will affect investment returns, we can't diversify away from that. We have to deal with it. So size is a really important driver of why we're focusing on these sustainability issues. The second issue for us is that we're so very long term. So we're not looking at the long term in terms of, 3 years or 5 years. We're looking at decades. We're looking at intergenerational responsibilities. So again, if you look at things from a systemic point of view, because you're so big, and then you look very long term because you're a pension fund, the issues that matter for risk and return look quite different. I mean, if you're a day trader moving quickly on share price movements, that's one kind of an investment strategy. It's not going to work for us. We're too big and we're too long term. So what we did some years back was write a set of investment beliefs. This was in the wake of the last financial crisis, to say, well, where do we think value creation comes from? Now, money does not grow on trees. We've got to make a 7% investment return, which is very high, a very high target. Why? Because the biggest chunk of money when we're paying out investment dollars, the money to pay the pensions, it comes from investment returns. So every single one of the 2 million people in the CalPERS pension fund is relying on the capital markets, relying on the stock market to produce those investment returns that go into their pension payments. So what we thought through with this project on investment beliefs was, what we've learned is that financial sustainability is an integral part of what we need to be focused on. The ability to pay pensions now and into the future and for future generations. So what we found is that the ESG acronym doesn't capture that very well. So what we've said in our investment beliefs is that for CalPERS, long-term value creation is going to come from the stewardship of 3 forms of capital. So financial capital, for sure. We're investors. We're putting money into public and private markets, debt and equity and so forth, but financial capital. But that's not the end of the story. The second consideration is physical capital. You think of everything in the natural environment that companies rely upon in order to do well and make profit and thrive. That's why we care about environmental issues. And then the third form of capital that matters is human capital. And we know full well that what's happening with the workforce, with the community, with the supply chain, all of this matters as well. So what we did was say, in order to create long-term sustainable value, we've got to understand how to manage financial capital, physical capital, and human capital. And on the back of that, we then said, okay, well, we now need to consider the next question, which is, out of those very big ideas, what really matters to CalPERS, given our particular size, status, where we are, our stakeholders, our employers who contribute to the fund. So what we did was commission a very big research exercise, basically stand back and say, okay, academics, we need you. And we had academics at UC Davis in California and Columbia with a team of other universities to just survey the scene, tell us what's out there. And in 2 rounds, we had a review of about 1,800 different research papers asking the question, what matters to risk and return in this sustainability world? And out of that, we identified a number of priorities. One was climate change. We could see, because of our size, because of our long-term liabilities, we needed a strategy that addressed protecting the fund from the risks of climate change, but also exploring the opportunities, because we're now finding that there's a lot of very attractive investment opportunities because of the climate change transition. So that was number one. Number two, the research showed us that the issue of diversity and inclusion really matters to performance. So we also built out a plan focusing on diversity on corporate boards. And we've done a lot of engagement and exercising our votes and working with other funds to have a real impact there. The third area was looking at alignment of interest, particularly in private equity, where fee disclosure was an area where investors wanted to actually know and understand more. Then we said research. The next thing in the priorities, number 5, was setting out manager expectations for each asset class on what we wanted to be integrated into sustainable investment strategies by asset class. So each of our asset classes has something called Sustainable Investment Practice Guidelines, which you can find on our website, which say, well, what do we think really matters when you're investing with fixed income? We're doing security level, fundamental analysis, what we're doing in global equity, where we invest according to a big global benchmark, very different strategy. Likewise in the private markets. And then the final part of it is a very big piece of work for us, which is we realized all of this work on environmental issues, climate change, diversity, governance, you name it. One of the barriers everywhere is that we simply don't have the corporate reporting. We don't have the data that we need. You know, at best, even on something big like climate change and carbon emissions, less than half of the companies in our portfolio disclose those. So you have to estimate and guesstimate and really cobble together a view of what's really going on. So a big part of our work has been arguing to regulators and standard setters that we need to start including these issues into the mandatory corporate reporting that companies do. So we've made big progress on climate change. We've now got, we're expecting next year with COP26 that the issue of mandatory climate risk reporting will be on the agenda. And the International Financial Reporting Standards folks have issued a paper, a document discussing how to do that without having to enter into a whole new rule writing process. In the United States, we've made great progress on human capital management reporting with recommendations at the SEC, where we're arguing that right now we don't, as investors, have any real insight into human capital issues. And you look at what's been happening with companies and the economy through the pandemic, we know nothing about health and safety, wages, recruitment, benefit, paid sick leave, things that are really important to the management of this pandemic. So I think on both of those fronts, we're really seeing momentum around the idea that corporate reporting has got to capture sustainability, drivers of risk, and sustainability drivers of return. Otherwise, we're just missing out a big picture, a big piece of it. So
yeah, and I want to. Yeah, thank you for that. I'm sorry to interrupt you. I just want to talk a little bit. We've got a few minutes left, and that was a great explanation about. I mean, it was amazing about your perspective and how it's evolved. But you talk about data, and from what I, as a layperson from outside the sustainability, the world, there are some challenges with collecting data. You talked about it. Yeah. How was the CalPERS team kind of constructed? I mean, you had this portfolio, you had these clients that you're, these holdings that you have. How do you go out and gather the information or estimate what what the impact could be to the environment or could be to human capital? I mean, you've got to estimate if you don't get actual figures.
No, absolutely. So let's take climate change as an example. One of the first things we wanted to do in 2015, when the Paris Agreement, the international plan for how to deal with climate change was being negotiated, we wanted to know where greenhouse gases were in our portfolio. Like, how much of this problem do we own as CalPERS? And so one of our specialists in the investment office, Divya Mankikar, who's a data specialist and climate change specialist, what she did in piecing together a review just to produce this carbon footprint was having to use 3 different sources of data providers. Then we had data for about 40% of our 10,000 company holdings. And she then had to develop a modeling approach where, if one company in a sector is giving you data, you could then use that to indicate what may be the case with another company. Now, there's a real problem because the companies with the better story to tell are typically the ones that report. So you get lots of false positives. So you have to adjust for that. But what we found in that process, and this is why data are so important, is of our 10,000 holdings, less than 100 companies were responsible for most of the emissions. And that's what led to us convening Climate Action 100 Plus to say the financial community can tackle the issue of emissions with these big companies and bring those emissions down if we work in an alliance. And we now have nearly $50 trillion organized around engaging those companies. And we're getting some very big results in terms of companies committing to get to net zero, which means their emissions would have come down 70, 80, 90% in coming years. So it's a very big deal. But it's a great example where the data can lead you to the solution, help you learn what you need to do. But, while it's a hodgepodge of voluntary and, ad hoc reporting, is actually very difficult to construct a good view. So that's why we're pushing so hard with regulators in the US and in the overseas markets to get this pushed forward. Now, we've just been involved at the CFTC, the Commodities Futures and Trading Commission, which deals with the big commodities in the US, the oil market, wheat, dairy, and so forth. Divya sat on that climate change risk committee that the CFTC formed, and they've come out with a whole pile of recommendations on what needs to be done to protect financial markets from climate change risk. One of their recommendations is carbon pricing, for example, which we fully support. And the other is mandatory risk reporting. So I think what you're seeing on both sides of the Atlantic is, investors saying we not only request, we require that this type of reporting be done. That's going to make all the difference to us being able to deploy capital more effectively, but also to act as stewards of that capital through our voting and other rights that we have.
Yeah, absolutely. And it's an absolutely fascinating subject. Really appreciate you coming on the program this morning to give us a little bit of the lay of the land, and congratulations on hitting your benchmarks and in terms of where you're going with climate change and sustainability. And we look forward to having you on the program again very soon.
Thanks so much, Jeffrey. It's a real pleasure to join you.
Well, thanks, Anne. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. On Monday, I sat down with the Institute of Student Loan Advisors, Betsy Mayott, to discuss what credit score you may need to get a student loan. Let's take a look.
Well, it depends on what kind of student loan you're getting. Thankfully, the student loan that we tend to recommend the most, federal Stafford loan, there's no credit check. So as long as you don't currently have a defaulted federal student loan, you'll get approved and are otherwise eligible, you will get approved for a federal Stafford loan. Federal plus loans, whether it be a graduate plus loan or a parent plus loan, there is a credit check. However, it's different from the type of credit check that most people are used to. They don't look at your actual credit score, for one. They also don't look at your debt to income ratio. What they are looking for at a high level are active or recent significant delinquencies or other things like judgments or defaults or charge-offs, that kind of thing. So once you get beyond the federal student loans, private loans are a completely different ball of wax. Private student loans, they do what most of us would see as a more traditional credit check. However, some of the private lenders are also looking at what school you're going to and what you're studying as part of the approval process. In general, if you have a credit score of at least, say, 670, 680, you might be able to get a private student loan without a cosigner. But the vast majority of student borrowers that are applying for private student loans are going to need a cosigner. Or even if you're going to be approved in the first place. Those of us that work with student loan advocacy usually really strongly recommend against private loans, period, for the very reasons that you just illustrated. If things go south financially, whether it be because of a pandemic or any other reason, private loans tend to have very few, if any, options for relief. So we tend to recommend that people stay within the federal loan program. What I tend to see is, especially with parents, is they want the loans to be in the student's name. So they'll shy away from the Parent Plus loans, but they'll agree to co-sign on a private student loan. What they don't understand often is that co-signing on a private student loan makes you equally liable for that as the borrower. So the effect to your own credit report is the same as if you'd taken out the Parent Plus loan. So, which is another reason, and Parent Plus loans, as you know, have a lot more options for relief if something goes south financially. So that's why we tend to recommend people use the Parent Plus loans if it's affordable for them to do so versus co-signing on a private student loan. I think at this point, things are changing with additional stimulus packages like minute by minute, really at this point. what I'm hearing at, this morning on a Wednesday morning is that, the talks have sort of stalled, but that could change by this afternoon. I mean, overall, I think it's going to really depend on the outcome of the election at this point. We're only 2 weeks away. The outcome is really going to make the difference. But if things were to happen today, excuse me, the Senate doesn't really have any additional student loan relief in the proposals they've offered, whereas the House has some significant additional relief. So, and that's really how politics works. Usually, sometimes you end up somewhere in the middle.
Yeah.
But, the other thing, other than post-election, is I think there's a lot of let's wait and see what the economy and the pandemic is doing, after the holidays. So there's a couple different goalposts here that we're looking at.
And on Thursday, I also spoke with MarketWatch's Jacob Passy about new reward card perks that may alter the industry. Let's take a look.
So the rewards credit card space is going through a lot of upheaval at the moment. A lot of the big deal credit cards, the Chase Sapphires, the Amex Gold cards, are less attractive right now because they're travel oriented. And obviously travel is not as popular right now because of the pandemic. Lots of folks haven't been able to take advantage of, the benefits of those cards in terms of, free checked bags or, credits towards, travel expenses, things like that. And obviously also a lot of the spending typically with those cards that generates the rewards was also travel oriented. You got a better bang for your buck when you were booking airfare and things like that. So the world has changed a lot, and those credit cards have changed with it. They're rewarding different things right now. The Chase Sapphire, for instance, it has now boosted the cash back that they give or the points back that they give for restaurant purchases, takeout, delivery, things like that, as well as supermarket purchases. But for a lot of folks who have these cards, that's a bummer because you're paying a pretty steep annual fee for them usually. Yep. And, you're not getting all the bang for your buck. Card holders, there was the splashy debut just this month of the Venmo credit card. So Venmo is the payment sharing app where you can, pay your friends back for, split expenses like a bar tab or things like that. It's really popular with younger adults, Gen Z, millennials. And in the past, they had debuted a debit card, and now they've got a credit card. And what they've done with their credit card, it is a rewards card, but it has a kind of interesting setup to its rewards. So rather than having set categories that give you, points back or cash back, they do it in a personalized manner. So each month, the credit card will automatically examine your spending and will determine, where you're spending the most money. So you'll get 4% back on your top category from a range of categories that the app will automatically choose from. So, 4% back on your top category, 3% on the next, and then I think it's either 2 or 1% on the rest. I forget the exact details, but, that's a different model than we've really seen. There have been credit cards here and there where there were revolving categories, but this is one of the biggest debuts of a personalized rewards program that we've seen. And that could really change the market moving forward. You're totally right. It is the kind of entry of AI, machine learning into the rewards credit card space, which could really serve to the benefit of credit card holders. I mean, when I spoke with experts, one of my big questions was, is this going to take off? Because this isn't the first card we've seen in recent years that's debuted that's tried to change things up. So like the Apple Card, for instance, their kind of twist on credit card rewards is they offered daily cash back. So usually you have to let it accrue over a set period of time before you, can cash it out or whatever. But, with the Apple Card, they give you your cash back into an Apple Money account automatically. It happens, right after purchase, and you can use that money on the go, and they kind of have a similar function to Venmo when it comes to splitting payments. So you can pay friends back with that money, et cetera. So we're seeing different credit cards that, cater to tech savvy younger adults try these new things that are all kind of automated AI machine learning based. And that's a big deal because, as a lot of the folks who are getting these cards get used to them and used to these benefits, they're going to expect that of all credit cards. So when we're talking about the Venmo card, that's going to be really popular with folks who are, in their 20s. It may even be their first credit card because it's going to be easier for them to qualify for that card than, say, the Chase Sapphires of the world. And so when they have that as their first credit card, you develop an attachment to it, and you expect those things out of your next credit card. If you're going to give up space in your wallet, you want it to be serving you as best as possible. So if they're used to things being personalized and not having to do all the thinking that's involved with, gaming a Chase Sapphire card or an Amex Gold card, then, the Chases and Amexes of the world are going to turn around and probably start infusing some of those elements into their own cards. So it wouldn't be surprising to see in the next few years, Chase Sapphire offering some more personalized options and things like that. So credit card issuers have definitely been more flexible with things as a result of the pandemic, especially when it comes to travel-related rewards. And we're seeing, I think you've seen some airlines, when it comes to loyalty status, relax things so you don't have to necessarily travel or spend as much to maintain your status. Because a lot of folks just, for an extended period of time, we weren't even really allowed to travel in a lot of cases. And a lot of airlines are seeing a pickup in business, but it's nowhere near what we saw a year ago. So, travel is still down. One thing to be aware of, though, especially for folks who have credit card rewards that are tied to airline miles, is one risk that we could see in the future, and I'm not saying this is definitely going to happen by any means, but if there is an instance where an airline goes bankrupt, you'll lose those miles. Basically. They don't tend to have cash value. It's not like, if you've bought an airline ticket and the airline goes bankrupt, you'll get money back, but your airline miles don't have value outside of that airline. And so unless the airline were to be bought out by another airline or something like that, you might just fully lose those miles. And if it is bought out by an airline, then your miles would probably be converted over to their plan, which may or may not benefit you as much.
And that wraps up this episode of BRN Weekly. Don't forget, we're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, financial services, and others to analyze all the news in retirement markets, technology, personal finance, so much more. You're not going to want to miss it. Don't forget to check out our daily newsletter as well, The Morning Pulse, where you can find all the news in retirement markets, technology, personal finance, so much more too. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.